Hi traders, welcome to this edition of Expert Market Analysis brought to you by Arante. This is generally a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers shortly, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term decrease in importance over. So there are the few disclaimers that you get. Just what we hope 30 minutes or so. As I always say, our goal is market jargon and complexities that you read about. So if you do have any questions, please leave them away, and I'll hopefully get to those as soon as possible, or at least at the end of the webinar. Okay, it's Wednesday, just after 9 a.m. in London. So let's do it. First of all, we'll just check out how markets are trading currently, then look at current, mainly summer markets really, and what's happening what has been happening, of course, in Ukraine, equity markets as well. Before review of this week's main data points, UK PPI will and the RBNZ meeting and the left potentially for the Fed and the Bank of England there. We'll look at that big move in Kiwi today, selling off on that dovish cut. So we'll be against the dollar. Before they're looking at Jackson Hole, big tomorrow, but Fed chair speech on Friday, key risk event there. So we'll look at that. Other currency pairs as well as the dollar, the Aussie dollar, and the Japanese yen, dollar yen. Before then, checking out PMIs due tomorrow, and the euro dollar currency as well on the charts. Okay, so first up, summer markets really interesting that, overnight, APAC stocks traded mixed really after the lackluster performance stateside. We saw mega cap tech leading the declines with tech-heavy indices in Asia being hit. The RBNZ, as I said, lowered the OCR cash rate by 25 basis points as expected, but they cut their forecast across the projection horizon actually. And also there was a split vote on a 25% cut or a 50 basis point cut as well. Two members of the committee voting for that. So very much a dovish cut with forecasts as well. Equity futures, US equity futures marginally, lower actually, and Eurostoxx as well down. After, Eurostoxx gained with 0.9% gains on Tuesday actually, but they're now down today following stateside that lead on Wall Street. Dollar at the moment was marginally higher, pretty quiet really for a third session in a row, waiting for now, as I say, Jackson Hole, Kiwi getting smashed really and lagging after the RBNZ, and UK inflation data obviously being eyed up by sterling traders, which was hotter than expected. Services as well, and we'll get to that shortly. Just a mild bid in sterling, the pound at the moment. Interesting, the White House is eyeing up Budapest for peace talks with Zelensky and Putin, according to Politico. Otherwise, of course, obviously, that big news has been, or the focus has been on the Alaska summit that we had last week on Friday. President Trump and Putin obviously met to discuss the war in Ukraine. That has been a big theme, of course, this start of this week. Talks ended earlier actually and were unsuccessful by many media reports, painting it as a very downbeat meeting with Trump giving in to Putin. We did get that possible positive news that Stephen Witkoff, Trump's special envoy to the Middle East, said that Putin agreed that the US could provide security guarantees to Ukraine as part of the deal, which have been central to any peace path going forward. At that point, actually, over the weekend, it was likely Russia would require territorial concessions, which, of course, have been a red line for Ukraine. Also, Trump then decided to hold back on further sanctions against Russia, as well as secondary tariffs on countries buying Russian energy, such as ones he put on India. Since then, well, President Trump has met Zelensky at the White House, as well as other European leaders. Trump made, well, actually multiple mentions of security guarantees and a possible trilateral meeting, as I've said, between Putin, Zelensky, and Trump. However, that said, following that meeting, the Kremlin has actually yet to accept that proposal. NATO Secretary Rutte, he told media that the details of the security guarantees would be worked on over the coming days, but it was certainly a much friendlier tone in that White House meeting between Zelensky and Trump. Stark contrast, of course, to that last meeting in February that ended basically with Zelensky leaving the White House after collapse of those diplomatic talks. Going forward, I guess we'll see, we'll watch to see really if any more details emerge about the level of support the US is prepared to offer Europe in defending Ukraine. Big question mark there, really. And also then whether President Putin actually is prepared to accept essentially European boots on the ground in Ukraine. And of course, the threat of which under NATO, of course, prompted Russia to actually invade Ukraine in the first place. I think we'll just look at a couple of currency pairs actually as we go here, because just for your gauge, Euro Swiss is a very good gauge within this sort of area around peace and whether we get peace talks or more or less peace essentially. So it has been a good gauge. Euro obviously strengthening if we do get peace talks, and you've seen that after that low support level around 92.61. Then we got this build up into the Putin-Trump meeting. Prospect of peace was raised, and of course now we're sort of tracking sideways. Euro Swiss will go lower if there is no peace deal or advancement on the talks that we've seen and the points we've just raised. Otherwise, if there is an advancement, then potentially this will break. Euro Swiss will go higher and break then 94.50, looking like a sort of just below there. A decent resistance level. So just watch that as a really good gauge, as well as oil, of course, and whether then peace happens, oil prices would come off with Russian oil coming back potentially onto the market as well. So we just bring up oil prices, just bear with me, and I'll just find Brent crude, which is here. So then exact opposite in a way of Euro Swiss. So oil prices came off as this prospect of peace was raised in Russia, in Ukraine, with Trump and Putin meeting, of course, and now we're just tracking sideways again, waiting for more positive news headlines about potential security guarantees, of course, and then is there any kind of territorial concession that Ukraine has to give for those guarantees or not? So again, crude oil, a good gauge for peace talks around Ukraine. Just pulling up equity index chart now at the S&P 500. If we move on to stocks now, well, they retreated yesterday despite a European rally. Actually, 8 out of the 11 sectors in the S&P closed higher actually. So equal weighted index actually did okay compared to the market cap weighted index of the S&P. Sell off entirely tech driven, then absence a clear trigger. I know there were stories that circulated around OpenAI's Sam Altman admitting that investors are probably overexcited about AI, and we also had a report from MIT researchers saying that nearly 100% of companies see at the moment 0% returns from AI pilots. What we saw then in stocks was a sharp defensive rotation, really pronounced value outperformance, and small caps even outperforming large caps. Kind of mini correction in tech, really. comes after, of course, that strong run that we've seen post Liberation Day and that bottom in April. Recent weeks, then we've seen leadership narrow further, handful of mega cap tech names as we've highlighted previously, and many of which have reached fresh absolute and relative highs. Yesterday's session then was broad and largely devoid of macro headlines. We didn't get, well, weaker data, bit of housing, Fed expectations ahead of Jackson Hole. Of course, profit taking probably a big reason for the sell-off. And also actually earnings weren't in play either. Rather, probably a textbook case, as I said, of profit taking after a powerful tech rally, then that cascaded into a sort of negative feedback loop. So we got the S&P down 0.6%, but the Nasdaq down 1.5%, the Dow up 0.2%, defensives doing better. And in Asia, well, that's followed suit really, tech heavy indices, as I said, under pressure, futures pointing lower. Nvidia, just for your guide, that fell 3.5%, so that was its biggest drop in nearly 4 months. Palantir, that plunged over 9.3%, really on those stories around just Sam Altman, as I said, and those MIT research story. For stocks, then you can just see it's sort of what has been trading up through, if I just extend that bull channel from those April lows. Yeah, we've just been tracking the lower part of that channel, and then potentially now we've just pushed through and down below it. You can see record intraday highs at 64.81, and then you've got the 50-day moving average down below. Tallies probably with that swing low that we saw at the start of August, 62.12, and the 50-day moving average at 62.46. Nasdaq similarly should really raise this previous high, which is at 23,573. We've moved down through that. So the current high now is at 23,696. So I'll move that at some point. You've got the 50-day moving average just above that August low at 22,820. But you can just see how big that move is really. So initial support potentially just a bit way lower or below where we are currently trading. The Dow did better, of course, as I said, just marginally higher, and the previous high is just above 45,054, intraday high at 45,207 actually yesterday's high intraday, but then we closed just marginally in the green. So support really not down, yeah, but possibly down to the 50-day moving average. That's at just below 44,000, but very strong resistance, it would seem, around the 45,000 mark above. Okay, let's now move to what we're looking at next. Just one chart that I did show you last week, actually, which was just around the VIX, the volatility index. So that's Wall Street's fear gauge. Basically, it is a live index, which shows 30-day options prices for the S&P 500. And generally has been around sort of averaging 17 long-term average, touch higher over the last 10 years or so. But you can just see, yeah, August generally has been one of the more elevated months, the most elevated actually for volatility. Summer markets, as we've mentioned, thinner liquidity, many traders on holiday, central bankers, policymakers on holiday, etc. So yeah, you do get whippy markets, but at the moment we haven't really had that. So just interesting point as we move into Jackson Hole especially. Okay, let's move on now to well, most recent risk events, UK CPI and RBNZ. We've got a chart really just with the sort of sticky inflation dilemma that the UK is seeing. This was before the numbers that we got out this morning. Kind of reality check, the first reality check after that most recent hawkish Bank of England rate cut that we saw on August 7. UK July prices that again printed on the higher side of expectations. A headline rose 0.1 month on month to 3.8, then from 3.7%. Core rose also to, that's 3.6%. The previous headline inflation number, that rose to 3.8%, and then core rose from 3.7 to 3.8, while services, you can see here, was at 4.7. That accelerated from 4.7 to 5%. So yes, quite a conundrum, quite a dilemma for the UK and the Bank of England. Services, well, was generally down to rising airfares, which may be looked through by the MPC. They're more concerned about food inflation, and that has been relatively steady recently. But money markets, well, of course, they recently doubted whether the Bank of England would be able to continue policy normalization at that sort of previous quarterly 25 basis point pace. Those doubts, of course, haven't been eased by today's data, but sterling sort of only gained modestly immediately after the release. And if we look at a couple of charts, then cable first up. I'll just pull up that, which is here. Yeah, only a very modest bid actually. The same as euro actually as well, and euro sterling's actually gone higher, so nothing great after that data. Just have a look. We did move higher. You can see data came out at 7 a.m. UK time, and we did push higher, but then pull back. And we're sort of now at least at the highs of the day, although the dollar is lower as well. As for cable, you can see the blue lines of 50-day moving average has acted as support previously, even though we dipped down below it. Now we're back trading around it, 134.96, that 50-day moving average. Recent high, then initial resistance at 135.94, and then you've got that multi-year high made back in the start of the July at 137.84. Below here, below that 50-day moving average, we've got the cycle swing high from September, that's a 134.34, and then you've got the first Fibonacci level of this move higher, that's a 133.86. That's cable. We said we look at euro sterling as well. Interesting chart again, being held up by the 50-day moving average. Actually, that's at 86.22. You've got that first fib level as well of well, I've picked the low from February of this year. So this year's low, in fact, and then this year's high, that move higher, and the 23.6 retrace levels at 86.31 actually. So we're just trading around here. If we do break that, then potentially, yeah, we're looking to go up towards 86.50 and 87. Otherwise, support at the 50-day, and then these swing lows from mid-August around 85.96, just below 86 in euro sterling. Otherwise, we had the RBNZ as well, and an interesting move actually, and some pointers for the Fed and Bank of England, as I said earlier. The RBNZ, they lowered its rates as expected by 25 basis points, and I'm just pulling up a Kiwi chart here just to show you this impact. But it was very much a dovish cut. It was a split vote, as I said, 4-2, so 2 governors in favor of a larger 50 basis point cut, and that was seriously debated according to the press release. Inflation, well, that's currently around the top of the 1% to 3% target band, which of course is an issue for other central banks, as I say, but it is then expected to return to 2% by mid next year due to spare capacity and declining domestic pressures. That's a key point for other central banks, because of the RBNZ does have spare capacity, others don't, and so potentially that may be a pointer for those central banks going forward. Otherwise, for the RBNZ, the economic recovery stalled in Q2 with global policy uncertainty, of course, falling employment, higher essential prices, and declining house prices, all contributing. The committee then, they indicated scope for further reductions, further rate cuts if medium-term inflation pressures continue to ease. to help the economy and labour markets. But updated projections by the committee for the policy rate, they do suggest now a short-term potential towards 2.5% by Q1 of next year. That's the terminal rate then. That compares with 2.75% in the May update, so that's lower than previous. So is a dovish signal as well, although they say it will return then to a neutral 3% at the end of the policy horizon. Interesting, as I say, so these same battles being faced by both the Fed and the Bank of England in terms of how to react to higher short-term inflation. Certainly, those two banks don't have the same spare capacity, as I said, in labour markets as New Zealand does. But of course, the reaction in Kiwi FX and rates markets as well does serve as a reminder that if the labour market does show serious signs of softening, then the door's open for central banks to cut rates back to neutral or even below neutral, and you see rates getting hit and the currency getting hit as well. We've seen that in the Kiwi swap curve, basically yields falling dramatically. The 2-year end 17 basis points or so, and then even the long end by around 8 basis points. So that's basically bull steepening. And the Kiwi, of course, has sold off aggressively from, well, 59 to around where we are currently, just off the lows. The lows for today being around 58.15, and we're just now tracking the black line, which is a 200-day moving average. That's at 58.33, and then also this Fibonacci level 38.2 at 58.25. That's the fib level of the highs from September down to the lows in April. And the halfway point of that move is at 58.25. 200-day moving average just finding support then in this zone at 58.33 as well. So big sell-off in Kiwi and possible pointers for other central banks as well. Okay, let's move on now to this week's main events, of course, which are, of course, Jackson Hole and otherwise PMI data out tomorrow. A few charts here around Jackson Hole. First of all, just the change that we've seen in US interest rates, basically. So US Fed funds rates, you've got 6 months ago, the blue line, very few rate cuts priced in from, well, February, back in February, down across down to February 27, so 2 years hence. Not a lot priced in, but now, of course, where we are in August 2025, and you've got a terminal rate potentially below 3% for 4.25 to 4.5 at the moment. So interesting repricing, dovish repricing of Fed rate expectations. That is the issue. Really, is a central issue for Jerome Powell and his speech, which will be at 10 a.m. I think Eastern time. So 2 p.m. GMT, I think. But yes, that is the key risk event going forward. Then, of course, Jackson Hole has been historically used by Fed speakers to signal upcoming monetary policy changes, although actually that hasn't always held true in recent years. If we think about recent data, US data, it suggests it's probably too early for the Fed chair to unequivocally open the door for aggressive further policy more normalization just yet. Of course, we had that downbeat jobs report at the start of the month that got markets started to price in September rate cut, and that was then ramped up with the most recent CPI data not being deemed as hot as feared, so that further bolstered rate cuts, which are now probably, I think, around there's an 85% chance of a September 25 basis point cut priced by markets currently. We did then have the PPI data after that CPI data, which was much hotter than expected, and then we did see a little bit of dovish unwinding, but still very high chance markets think of a rate cut. Several Fed speakers, well, they have alluded to a move, but then others have appeared more reluctant, and certainly they're not in tune with Treasury Secretary Bessent, who's urged the Fed to begin a rate cut cycle with a 50 basis point reduction in September, and rates, he was saying, should be, say, around 150 basis points lower. So there's a lot of political pressures, we know, from Trump, from Bessent, from others in the White House. The question is really, will we get any signals that the Fed is looking more at or giving more weight to labor market softness rather than to tariff-driven inflation? As I've said, it's probably maybe too early for Powell to all but confirm a Fed move in September. We do still get one more non-farm payroll report at the start of next month, the first Friday in September, and we do get one more CPI report the following week on the 11th of September. That is then a week before that mid-September FOMC meeting. Perhaps probably you kind of think only when the facts of a solid labor market change, and Powell had said the labor market was solid just before that NFP report. So only when those facts change will then Powell have to acknowledge and then potentially move on rates. You also think that, or we also think that the missteps after COVID and the transitory call around, of course, super high inflation means that they will be conscious of not cutting too early. So that's Jackson Hole really. We do, here's just the CPI data, previous data and charts just around the core and the headline, and of course where we are with the current benchmark, and just this idea about whether we do get tariff-induced inflation going forward, but we haven't seen that yet because retailers, businesses have been absorbing tariff costs, but how long that lasts and whether it then feeds into CPI, we shall see in the months ahead. Whether it's just a one-off price adjustment and then really labor market weakness kicks in is the issue, of course, for Powell and the FOMC. We do get other Fed speakers at Jackson Hole as well, who will give their views on policy and the economic outlook, and also potentially explain their thoughts on that recent NFP report and inflation data too. So watch out for those speakers tomorrow. Also should say we do get Fed minutes out later today. Markets will be on watch for any signs that rate cuts are incoming, even though Powell leaned hawkish in his press conference and he pushed back against that September rate move. Then they're kind of probably a little bit stale, these FOMC minutes pre-NFP as well. Although of course the meeting did have a very rare dissenting vote with Governors Waller and Bauman both voting for policy easing. Just before we get to PMIs, let's go through a few charts then. So if I just find the dollar index chart here, you can just see we're just trading around the 50-day moving average, that blue line. It has acted as resistance previously, although we broke above it, but then pulled back down towards it. That's at 96.03. Then you've got these swing lows from late August at 97.42, and then that long-term low at 96.37. Thick dotted line there, just for your guide, is a long-term upward trend line from 2011 lows, and then it tapped and capped downside in 2021 as well, so acted as decent resistance there. So just watch out for that, which is just above that long-term low at 96.37 if we do move lower. Otherwise, if Powell certainly pushes against rate cut expectations, which is probably the main expectation really. So in a way, if he's slightly more dovish than pushing hard against rate cut expectations, then the dollar will turn lower with 96.03 resistance, and then that sort of big trend line to watch out for. Otherwise, if he's much more hawkish than even expectations, and he does offer a strong pushback against September and even beyond that, then yes, you've got a strong resistance zone around the first fib level at 99.63, and also a swing low from July 2023 at 99.57. You can see there, and that cut the upside in late July, early August. Okay, moving on from Jackson Hole just to PMI data just quickly. Here's a really good matrix that Reuters put out with all the different countries and what we've seen over the last few months. Blue being numbers in expansionary territory for PMI data, red being in contractionary territory below 50. Yeah, these business surveys, they can show economic trends months before they appear in official data, so that's why they're widely watched, and they will offer more clues actually about whether US tariffs are driving the world's largest economy towards possibly stagflation, so that's stagnant growth and buoyant inflation really, or whether growth momentum is still potentially continuing, and most numbers are in the blue, so in expansionary territory. The main PMI number is the Eurozone one, so just in a little bit more detail, manufacturing, that's forecast to remain below 50 at 49.5 from 49.8. Services expected to remain just above 50 at 50.7 from 51.0. That means the composite will remain above 50 as well, 50.6 versus 50.9. That composite index actually matched an 11-month high in July, despite a marginal downward revision in the final release. That said, the rate of growth remained modest and could see some softening in growth momentum if we're looking at other surveys like the Centix index and also the ZEW German Business Survey. So that's Eurozone data. Just for your guide on pricing wise, money markets, they price just a 6% probability attached to a 25 basis point rate cut in September now. And markets really struggle to price in a full 25 basis point rate cut until, well, spring next year now, actually next April. So adjustment there as well. And that has been helping euro dollar. If we just look at that to wrap up things, before then, just actually looking at a few other majors, which I said I would do. So euro dollar, you can just see here, supported by that blue line, the 50-day moving average, and yeah, sort of bullish momentum slightly tailed off. The 50-day moving average is at 116.43. You can just see the daily RSI around 50 now, so pretty neutral. So that will act as first support. If we do hold here, then you've got initial resistance around that mid-August high at 117.30, and then you've got that multi-year high from the start of July at 118.30. If we do lose the 50-day moving average, then probably notable support is around probably 114.39 in euro dollar. I did say I'll look at just quickly some other majors. You've got dollar yen here, will move on Jackson Hole for sure because it's correlated, has historically been correlated with 10-year US Treasury yields. Again, 50-day moving average acting as support, 146.63, and resistance above is the 200-day moving average at 149.15, and that tallies with the halfway point of this move lower at 149.37. Otherwise, just briefly as well, Aussie dollar, just to check that out. Support, which we're probably on now, which is at 64.27. Otherwise, black line below that, 63.85, and then resistance above around 65.49 really, which is a 61.8 fib retrace of this move lower. As well, gold, just in case that moves on Jackson Hole, of course. We did move low and looks like we were breaking down towards this first support level around 32.83, but haven't got there yet, and there's a small bid in gold today. 50-day moving average, that's at 33.48, and then you've got this sort of resistance from that high at 3,500, which comes in around probably these highs here from the start of August, around just above 3,400 in gold, just for your guide ahead of Jackson Hole. Okay, we will wrap it up there. Thank you so much for being all on the call. Really do appreciate you taking the time. Yeah, lots to look forward to with the Jackson Hole conference, of course. So do take care of that, and we will speak to you in a few weeks.